CeFi blew up. Why? Because if you are going to build a business that requires leverage to function on a fucking 100-volt asset, you are smoking crack. Hi, everyone. Welcome to the final kind of year's episode of Raoul's Adventures in Crypto. Or at least certainly the last one I'll be doing because I'm going away on holiday, finally. Well, I've just had a holiday as well, but I'm still in desperate need one. It's been kind of a hell of a year. And I wanted to recap, about where we are in the crypto markets, and then a lot of what I've learned this year from Raoul's Adventure in Crypto. I'm so blessed to be able to do this show and get the most important people in the world on it. And for such a broad range of topics, from layer ones, layer twos, to NFTs, culture, through to hedge funds, through to metaverse. I mean, I am so lucky to be able to pick these people's minds over where the world is going and take you along with me on that journey. Anyway, it's kind of an evening session, and so we're going to have a glass of wine, because frankly I deserve it, and a fireside chat, and tell you what's what. So, where are we in the crypto market? The most important thing about understanding crypto is understanding how to price it. And how I price crypto is essentially two major factors. One is global liquidity, and I use global M2 as the main understanding of that. And then there's and that's the cyclical element. And then there's the technological adoption, which is the long-term logarithmic trend. So let's deal with the cycle first. The cycle is what causes all of the pain. And I've been in this space since 2013, and trust me, I know pain. The first time I bought Bitcoin was at 200. It went up to, I think it was 1,000, then back down 85%, languished for a year or two, and then went up 10x from my entry price where I sold out. And then it came back down again after going up another 10x, then it came back down again. And I've seen these cycles. And at first, a lot of people correlated them to the Bitcoin halving cycle. And I think that's probably coincidental. And it's the fact that the economic cycle works in about the same time horizon, this 4-year period after 2008, that the Bitcoin halving cycle does, because it was born out of the crisis. And really what I think is going on is it's the debt refi cycle, because there's so much debt in the global economy. And what happens is they try and tighten rates, and then you've got to refi all of this debt, and rates come all the way back down again, liquidity comes back. And I think the stasis, the natural tendency is for there to be ongoing stimulus, because a overly indebted economy, and if you think of GDP growth being population growth plus productivity growth, well, with aging populations, that's out of the equation. And it seems that immigration is a political no-go, particularly with real wages so stagnant. So then you've got productivity growth. Now, that's not been growing either. So the only way of funding GDP has been debt. But now it takes $3 of debt to drive $1 of GDP. We kind of get to the end game, and there's just so much debt out there, it never gets paid back. So the only way of running an economy now is allowing for the increase in debt, but what services the debt is the cash flows. So therefore, GDP growth must be higher than debt growth. If not, you need to run negative real rates. GDP growth, because of aging populations, low productivity, has come down too low to service debt growth, and therefore you run negative real rates, quantitative easing, and other such stimulus. That is the way the world works. That was very clear in my interview with Arthur Hayes, a brilliant interview and well worth your time watching. And I think that's a key construct we all need to understand. So in the cycle, which coincides with the Bitcoin halving cycle, is the global liquidity cycle. And that's the central banks creating liquidity for the markets and for the economies. So what they tend to do is if the economy gets too hot, they tend to raise rates, liquidity comes down, they withdraw liquidity from the markets, take away QE. We've seen this several times before. And what happens is asset prices come down because they need stimulus. So once you take asset prices down, what happens is the economy starts headed towards a recession or goes into recession, and the monetary easing comes back again, because that's the natural state of affairs. So that's kind of how the world sets up. And right now, we're in the situation where we've got massive monetary tightening. Now, monetary tightening has brought down cryptocurrencies, not as bad as they were last time, certainly not the majors. I mean, Bitcoin, ETH, they got down to 70, 75%, which is, ETH last time, the last cycle in 2018 was down 95%, much like Solana is now, more on that later. And Bitcoin was down 85%. So we're seeing a less dramatic tightening because there's more people involved in the network, which is the growth of the network is more robust over time. We'll come more into that. So if you look at this chart here, this is the year-on-year global money supply versus Bitcoin. And you can see they're hugely correlated. Now, what's interesting, you see the tops of the charts, they're all missing because the scaling doesn't work. Because of the technological trend adoption, when you get the rallies, they tend to massively overshoot, even versus where liquidity is. And that extra is the extra trend that drives the markets forward over time. Now, every time we see these trends, the boom and bust, everybody shouts scam Ponzi, but that scam Ponzi phase is actually just driven by the monetary tightening cycle. Now, there is a lot of speculation in crypto, I get that, because there is, in most new technologies, we get that in technology stocks themselves. So right now, we are at the bottom of the monetary cycle. Going forwards, we know the Federal Reserve is going to start increasing rates at lower increments. I don't think they go much further than maybe this 50 now. Maybe they try and eke in another 25 and try and keep rates stable and then wait for CPI to fall below Fed funds rates, which I think happens March, April. So I think next year is a game of dramatically changing liquidity conditions. Now, I also have charts to show that too. I've got chart of global M2, and you can see it versus ISM. ISM leads it, inverted on this chart, and it says when ISM starts falling, global M2 follows and turns around. And that means because ISM is saying growth is falling, and therefore monetary liquidity needs to come back in to save and manage an overly indebted system. So that's the typical state of affairs. We're exactly at that kind of turning point. So that's where we are in the monetary cycle. I think we will see inflation fall much faster than people expect, and therefore stimulus will come. And I think the Fed are going to think or look somewhat stupid by about June, where I think inflation is going to be down closer to 2%. I mean, the year-on-year rate of change of oil prices alone is probably zero right now. And if oil goes to $60, where I think it goes, and we get into March of next year, that was the time from the Russian oil crisis premium of about $120. So oil will be down 50% year on year. That's incredibly negative for an inflationary